Look at that. Let's go shopping.
Oh. This is beautiful. I wonder how much is it? £60? How much is it in RM? Have you ever wondered how exchange rates are determined? So basically, exchange rate is a rate that you can change from one currency to another currency, whether it is for international trade or for individual transaction by traveler. Most exchange rates are defined by floating. They will rise or fall based on the demand in the market. There are two kinds of exchange rate, which is flexible exchange rate and fixed exchange rate. A flexible exchange rate changes constantly on a moment-by-moment basis. For example, USD dollar, UK pound, Korean won, and so on. While the fixed exchange rate doesn't change unless government says so. For example, Saudi Arabia Riyal and the Bahamas. Hi and Assalamualaikum, my name is Shazana Afza. Me and my group will explain to you what is the factor that influence exchange rate. It will consist of 4 main points, which is inflation, interest rate, government debt or public, and also political stability. So let's get into the journey.
Inflation refers to the rate at which the general level of prices for goods and its services rises, and it will affecting the purchasing power of the country. When a country experiences high inflation, its currency loses the value relative to the currencies of its trading partners. This is because higher inflation reduces the currency purchasing power, making goods and services more expensive and less attractive to the foreign buyers. As a result, demand for the currency decreases and it leads to the depreciation of its value. First one, purchasing power parity. The concept of purchasing power parity suggests that in the long run, exchange rate should adjust so that the identical basket of goods costs the same in the two different countries when priced in a common currency. When a country experiences higher inflation than its trading partners, the price of goods and services increase more rapidly. To maintain the purchasing power parity, the value of the high inflation country currencies must depreciate and relative to the currency of its trading partners. This depreciation restores the balance, making the high-priced goods relatively cheaper in international terms. And for the second one is export competitiveness. High inflation makes a country export more expensive and less competitive in the global market. As the price of goods and services rises, foreign buyers may turn to the countries with lower prices. This decline in demand for export leads to the decrease in demand for the country's currency, and it will also contributing to its depreciation. Conversely, low inflation keeps export price stable, maintaining competitiveness and supporting a stronger currency. And for the third one, investor confidence. Inflation affects investor sentiment and confidence in a country's economic stability. High and volatile inflation can create uncertainty about the future value of investment. Foreign investors may be wary of holding assets in a country with high inflation due to the risk of currency depreciation. This can lead to the reduced foreign investment, further decreasing the demand of the currency and is causing to its depreciation. Conversely, low and stable inflation fosters a favorable investment environment, supporting a stronger currency. And for the last one, real return on investment. Inflation erodes the real return on investment. For instance, if an investor earns a nominal return of 5% on an investment, but the inflation rate is 3%, then the real return is only 2%. In high inflation environments, investors seek higher nominal returns to compensate for the loss of purchasing power. If domestic investment returns are insufficient to offset inflation, investors may seek better return in other countries, leading to the capital outflows depreciation of the domestic currency. For example, consider a country experiencing an annual inflation rate of 10%, while its trading partners have an average inflation rate of 2%. The higher inflation rate means that prices in the country are rising much faster than its trading partner. As a result, the country goods become more expensive for foreign buyers, and it will reduce the export demand. And at the same time, domestic consumers may find the imported goods much cheaper, and it will increase the import demand. This imbalance results in a trade deficit and a lower demand for a domestic currency in foreign exchange market, causing the currency to depreciate.
Another factor that influences exchange rates is interest rate. First, the disparity in interest rates between two countries directly affects the exchange rate between the currencies. Higher interest rates in one country attract foreign investment, increasing demand for its currency and depreciation. For example, in 2022, the US Federal Reserve raised interest rates while the Bank of Japan maintained ultra low rates. This caused the US dollar to appreciate against the Japanese yen. Next, central banks use changes in interest rates. Raising interest rates can help combat inflation and stabilizes the currency, while lowering interest rates can lead to currency depreciation. For example, in 2022, the Bank of England raised interest rates multiple times to tame inflation in the UK. The British pound gained value against currencies like the US dollar and euro. Furthermore, anticipation of future interest rate changes influences current exchange rates. Market participants monitor central bank statements and other indicators for interest rate adjustments that impact currency valuations. In 2019, the US Federal Reserve cut interest rates to support the economy. However, the dollar still gained value as markets expected the Fed to cut rates, further due to investors' anticipation of higher returns. Last but not least, countries with stable political and economic environments typically maintain higher interest rates. The perception of stability creates confidence in the currency, leading to appreciation. So the example would be Switzerland. Throughout the 2010s, the Swiss franc appreciated against currencies like the euro and US dollar, largely due to Switzerland's reputation for political and economic stability, which attracted foreign capital and supported the franc's value, despite low Swiss interest rates.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Abdul Rahman. Factor that influence the exchange rate is government debt. So government debt refers to the total amount of money that a government owes to its creditors. This debt is usually in the form of bonds or loans. Public debt specifically refers to the portion of government debt that is owed to individual citizens, institutions, and foreign governments. It is essentially the debt that the government owes to the public. So a country debt rating is also a factor that influences its currency exchange rate. Public sector projects sometimes require large-scale deficit financing which boosts the domestic economy. However, foreign investors are less likely to invest in countries with large public deficits and government debt. Fear of debt default can result in the selling of bonds denominated in that currency by investors, resulting in a fall in the value of the exchange rate. So government may also need to print money to pay parts of a large debt, resulting in inflation.
So, Assalamualaikum. I'm Nur Shafika. We present to you regarding political stability. Political stability is a exchange of currency that influenced by political stability of particular country. So, foreign investors are more attracted to invest in a country in display a low propensity for political turmoil. The injection for foreign investment that will lead to appreciation of the domestic currency and also unpredictable event that leading to unstable condition in the country, which means less foreign investment naturally leading to depreciation in domestic currency. Canadian multiculturalism, which is revealed as enduring political division, and the country history of negative treatments of indigenous people, the western province and the central regions are significant issues, which is the decline in effective parliaments and also predictable enforcement reflects the attention in political institutions, which also make controversies surrounding.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Alawusta binti Syaramunga. In the conclusion, the exchange rate of the Canadian dollar is very influenced by the complex interplay of several factors such as interest rates, government debt, and political stability. High interest rate tend to attract foreign investment, strengthening the Canadian dollar, which is CAD, while lower rates can lead to depreciation. Government debt levels very impactful to the investor confidence and can either support or weaken the currency depending on the fiscal sustainability perception. Political stability generally supports a stronger CAD by fostering a favorable investment climate, whereas instability can lead to the currency depreciation. By understanding these factors, it is very important and crucial for stakeholders in Canada's economy as they collectively shape the environment in which international trade and investment occur. And that's it for our group. And thank you for watching. Thank you.